only 4 halvings. They argue that it's hard to judge their significance when other factors like global liquidity, interest rates, and broader monetary or fiscal developments are usually at play. Moreover, a mix of new factors arguably make the halving even less relevant, as Bitcoin's demand and market dynamics have changed completely. Miners no longer exert major selling pressure, and their influence has faded. But the biggest shift is Bitcoin's adoption by institutions, asset managers, hedge funds, and even some banks. Some publicly traded companies have started buying Bitcoin to become DATs, and these new players now have a far greater impact on market sentiment and price action than the miners. Moreover, their focus on large, long-term investments rather than short-term trades has made Bitcoin more consistent and less volatile. In any case, the authors then address Bitcoin's biggest security threat: quantum computing. While not an immediate danger, it may be approaching faster than many expect. Its immense power could someday break Bitcoin's encryption, putting private keys, accounts, and funds at risk, a scenario dubbed Q-Day. Quantum computers could also mine blocks far more efficiently than current Bitcoin miners, potentially disrupting its economic model. Despite this, though, the authors call quantum computing, quote, a lower priority concern due to its current limits, but they do stress that migrating to quantum-resistant signatures is urgently needed. Luckily, plans to address these risks are in development, which is frankly beyond the scope of this video. Next, the reports examine Ethereum's ETH, which had a wild 2025. ETH dropped 60% from January to April, but reached new all-time highs by late summer. And this was driven by 2 main factors: institutional demand via spot ETFs and digital asset treasury companies, as well as the Pectra upgrade, which improved Ethereum's UX and scalability. In 2026, the authors say a renewed ETH uptrend will rely on macro tailwinds like lower interest rates, higher risk appetite, and easing monetary conditions. RWAs and stablecoins could be key drivers as well, since Ethereum holds a large share of both, especially stablecoins, with about 53% residing on Ethereum. Ethereum-focused DATs drove much of ETH demand in 2025, but as bullish momentum faded, their MNAV, or multiple to net asset value, dropped sharply, and this made them less attractive to investors, which could result in forced liquidations to stay afloat. Still, the authors expect DATs to provide a tailwind in 2026, though likely smaller than in 2025. The authors also touch on Ethereum's latest upgrade, Fusaka, which happened on December 3rd. Now, Fusaka implemented 12 Ethereum Improvement Proposals, or EIPs, to enhance scalability and efficiency. Ethereum's next upgrade, Glamsterdam, is scheduled for 2026, and it will further enhance scalability and efficiency while reducing centralization risks. Definitely one to watch closely. Now, the next part of the report focuses on Solana, which started strong in 2025. By January, Sol hit an all-time high of $295, but momentum faded fast. Over the next few months, it dropped more than 60% to around $100. Still, several bullish events helped support its price throughout the year, especially relative to Bitcoin. And these include the first Sol staking ETF, the debut of tokenized equities called X-Stocks, the Seeker mobile phone launch, approval of the Alpenglow upgrade, and the growing number of Solana-focused DATs. However, by Q4, macro pressures outweighed all of these. Concerns over tariffs, dollar liquidity, and inflation pushed Bitcoin lower, pulling the broader market down with it. Naturally, the authors expect altcoins to keep following Bitcoin in 2026, including Solana. Now, Sol's all-time high was driven by meme coins, which dominated most of 2024. But by 2025, traders were feeling the strain of the unforgiving PvP nature of meme coins. Sol's demand drivers then shifted from speculative retail to DATs, ETFs, and on-chain funds, all of which have longer-term time horizons. However, the authors did caution that if DATs continue to trade below their NAV, they won't be able to sell equity at a premium to buy more Sol, and may even be forced to de-risk by dumping some of their holdings. Regardless, a wave of fresh spot Solana ETFs opened fresh avenues for capital in the second half of 2025, and the authors expect more Solana ETFs in 2026 as regulatory roadblocks have been removed. And because many of these ETFs offer staking yields, these are expected to further boost demand in 2026. The authors also examine Solana's long-awaited Firedancer upgrade, which recently launched in a limited capacity on mainnet and is intended to boost Solana's performance, resilience, and client diversity, enabling up to 1 million transactions per second while keeping fees low during congestion. And this also supports complex use cases like advanced DeFi and gaming. The next upgrade, Alpenglow, was approved by validators in September and is set to launch on mainnet in early 2026. Alpenglow will enhance network latency, efficiency, and robustness, positioning Solana as a more mature, institution-ready blockchain and enabling use cases like payments, RWAs, and other high-throughput applications. Obviously, another crypto niche where Solana is dominant is stablecoins, which the authors examine in the next part of the report. Now, stablecoins have seen a compound annual growth rate of about 63% since January 2021. Transaction volumes soared from $22.8 trillion in 2024 to $47.6 trillion in 2025. The authors do note that future growth will depend on efficient ramps, broad distribution networks, and the evolving roles of market participants. They also note that over the past 2 years, stablecoins have grown from a mere convenience to a core part of digital settlements, vital to the global financial system. Their role in cross-border remittances and fast settlements makes them ideal for high-frequency, time-sensitive transactions, as well as collateral in DeFi and tokenized economies. And then the report looks at the interplay between the rise of stablecoins and the ongoing trend of de-dollarization. In short, the proliferation of dollar-backed stablecoins is supporting the dollar's dominance, which could paradoxically slow the de-dollarization trend and hinder crypto's adoption, at least in the context of replacing fiat currencies. The authors note that stablecoins have moved beyond their USD-centric roots, and a new wave